Welcome to another episode of the Wealth Building Strategies podcast. I'm your host, Jeremy Constantino, and today I'm super honored to have as a guest Matt Hansen. Welcome, Matt.
Hi, Jeremy. Thanks for having me.
Yeah, thanks for coming on. So, Matt is a retired corporate executive from Dow Chemical, correct?
Yep.
In Michigan, and he has transitioned full time to being an investor, real estate investor, and you have investment portfolio that includes over 2,000 units, multifamily apartments located across the South, Texas, Tennessee, and Florida. So welcome, Matt.
Thank you. Appreciate it.
So let's jump right on into your experience of being at Dow. And so what did you do at Dow Chemical?
I was a global supply chain director.
Okay.
A big, long word for the guy that's responsible for getting product moved all around the world, mostly hazardous chemicals. So you can imagine a little bit stressful at times.
So how long?
Fortunately, go ahead.
How long were you with Dow?
30 years.
Wow. Okay.
Yeah. So I did my time there, but it was a great experience. I love the company, excellent company, great to work for. But it was a great experience, and a lot of it was transferable to real estate investing, particularly large apartment complexes. Because basically every large apartment complex you purchase is a project. It's a business in its own. So it was just running a business. So it was a pretty smooth transition. It was fun. That prepared me quite well.
So when did you retire from Dow?
About 2 years ago.
Okay. So how was that transition and retirement? And so talk about the transition into real estate.
Well, I'd moonlighted and nobody knew it for probably 4 years, maybe more than that. So I'd done passive investing probably 6 years ago is when I started that.
Okay.
And passive invest for a couple of years. And it's really good. Passive investment is a limited partner. So I'm just putting money into deals, syndication deals, large apartment syndications, primarily in Texas at the time. And so it's just passive. You write a check, sign some paperwork, and you're in. And then you make a lot of money, typically.
I like that. That's nice.
And so I did that for a couple of years. And then I decided, you know what? I'd really kind of like to get involved in the general partner, which are the people that run the deal. They find it, acquire it. They deal with the lender and the insurance company and the attorneys and all that stuff. So I quietly did that behind the scenes for probably 4 years, 2 or 3, 4 years. And I would run the deal. So when we get them under contract and then till we close, I would kind of run it because I'm a business guy. That's what I do. So I'd partners, and the partners would raise the money. So they'd go out there and publicly raise money and things like that I couldn't really do safely. And so that was great. And then when I retired, I decided, okay, I can go ahead and put my name out there, and here, this is what I'm doing. It's not a side hustle. This is my full-time gig. I'm really focused. Go ahead.
How many hours a week would you say you moonlighted?
Shouldn't say I work more in real estate than my corporate job. But at that point, I'm paid not for what I do, but for what I know. At that, when you 30 years in the company, you pretty much show up for meetings and stuff like that. So I never did any transactional work the last 10 years or so. It was just management level, which is fine. So you do, and your salary, if you work 60 hours, you just get paid your 40. So, and I had no problem squeezing in the real estate with what my responsibilities were at work. So it's enough said. Don't get me in trouble, Jeremy.
It's okay. So I work with Chevron Oil and Gas Company out of college. So out of college, I worked. I think 15 years with Chevron Oil and Gas, and I kind of did some moonlighting too. So
just a secret between us and all the listeners.
Secret. Yeah, just secret. Oh, so I think we all have, us real estate investors. There's always a little spark that really makes us want to do real estate investing. Was there a spark for Matt?
I always loved real estate. Like when I was in college, I got a management marketing degree and a minor in economics. But I had an elective class, and it was real estate. And it was basically the pre-class to take the real estate realtor exam. Because I just wanted to learn. I thought, I'm going to buy a house someday. I want to know this. So I took the class. It was a 1 credit class. So I loved it. Really, really loved it. And I wish at that time I would have really pursued it. I thought, no, that was just kind of fun to know. But I've always had that interest in it. And then after my wife and I got married 33 years ago, we decided, you know what, we're going to buy a house and fix it up. Because I grew up on a farm and in a drugstore and a pharmacy, both kind of odd. And I had shop class and stuff in rural areas. So I know how to fix stuff. I know do electrical plumbing. I can do all this stuff. So when we first got married, we bought a fixer-upper house and we live in it for a year. So I only had long-term capital gains. I was smart enough to know, okay, I don't want to create more income tax, for my earned income. So we'd hold it for a year, and then there was no pressure. In the evenings, we'd work on it. My wife would come and paint, and we'd do stuff. And so we did. Oh, I think overall we probably did 15 houses over the last 33 years.
Wow.
So we did quite a few houses before. Then we had our first son, which is 27 now, and he's running around the floor in the house that we're living in as we're renovating. And it's plywood. We thought, okay, we can't do this anymore. So we stopped doing it for like 18 years. And both our kids went off to school and all that. And then I got back into it about 6 years ago. And I thought, okay, well, I'm going to just flip another house on the side, for fun. And while I was doing that, I was listening to podcasts because they became popular. And I heard about this thing about multifamily syndications. Thinking, hold it. That's just like business stuff. I love business stuff. So I finished that flip. We flipped that house, and I mean, we were making decent money on the flips, but it's one a year, and you're making anywhere from 12, I think, grand was the worst, but up to 65,000 or so on a house. So it's decent money. And that's when the light bulb went off. What am I doing here? This is something I could do until I'm 80 years old. So then I stopped that, and I really focused on large multifamily. And I joined a mastermind out of Dallas about 6 years ago. So that's where I got the exposure to it, the education, which is really important. You need to know what you're doing, what you're investing in. So that's kind of how, long story, how I got into it was listen to a podcast, and I found, large multifamily. That's something I can do. I've got the skill sets for that. So that's kind of how I stumbled across it.
Yeah, that's good. I have children. I have 5 children, and so we've been doing fix and flips, and so we don't let the house have plywood in it. We'll just put the construction paper down.
We can do that.
And the hard construction paper that doesn't damage the floors. But the kids, what they do is they love drawing on there. They draw they make like little streets and houses on it, and they draw. They love doing that. But we've gotten to the point where we can't stay in the house. We move the whole family out of the house, like a Airbnb, for a couple months, do the hard construction, then move them back in.
There you go.
But yeah, that gets kind of old after a while too.
Yeah, that's not good. And when the little kids, we thought this isn't a safe environment, so we stopped that. But, yeah.
So I noticed on your website you have a story talking about your personal 401k and what happened during 2008. Is that something you're willing to talk about now?
Sure. And something I want people to know about, because I'm from a different generation than you, Jeremy. So when I hired in at Dow Chemical in 89, let's say 1989. And so, here's your 401k, your Fidelity 401k, max that thing out. The company matches 6%. I'm putting in 22. So I did that just like I was told to do. And that's where all my money was. Then I got into my 40s or so, late 40s. I'm thinking, hold it. I have all this money in here. I can't touch it. Because if I could have touched it, I would have retired long ago.
Right.
So it was like, okay, it was great that I'd done that, but I've accumulated all this wealth, and then it's all stuck in the stock market. And in 2008 and 9, like most people, I took like a $300,000-$400,000 hit. It just plummeted. And everybody says, well, if you didn't lose money if you didn't sell it. Now, my philosophy is, well, hold it. Now my basis is $300,000 or some $100,000 lower than it was. And it took probably 7 years to build that back up. You tell me I didn't lose money? The time value of that money, and I kept it at the extra 300,000 and earned on that. Think about that money. So that's the thing that Wall Street doesn't tell you. You don't lose money unless you sell the stock. But I did. I had 300,000 or 400,000. It was no longer in play that I was not earning money on. And that was just devastating. And still even years after that, and then we're flipping the house on the side, but that really doesn't do much in terms of moving the needle compared to what I was making as an executive. And then like 6 years ago when I discovered this so I was able to move some of my funds. Once I retired, you can move funds from a past employer, not an existing employer, but a past employer. You can move that into a self-directed IRA. So I rolled my funds, no taxable event. You just take it, roll it from Fidelity to a self-directed IRA company. There's lots of them out there, like Rocket Dollars one, Safeguard's another one that we recommend. And you roll the money over there. Now you have checkbook control over it. Now I can invest, passively invest. I can't invest in my own stuff. It's got to be arm's length away. So it's got to be somebody else's deal. I can invest in real estate, crypto. We have a lot of venture capital investments. A lot of our retirement money is in venture capital things that I'm investing with some of my other business partners. So you name it, we're in vineyards. We've got land royalties for gold. We've got construction, road construction company that's creating a new product that actually can turn any native soil into pavement by mixing it with water. It's incredible. That company's gonna be worth billions soon. Hopefully, it's approved by the DOT. Stuff like that I would never have gotten exposure to. It all sat in the stock market.
Yeah.
So my net worth just skyrocketed 6 years ago when I started, was able to do this stuff. So if you got money sitting in a past employer's IRA, think about rolling at least some of it out of the stock market and passively invest in real estate or other alternative investments.
That's so good. Yeah. Even my generation, or Gen X, well, Gen X generation, whenever I joined Chevron Oil and Gas Company, they had a really nice matching 401k plan, and I took advantage of that. But it was the same thing when it was when I'm in my 30s. I'm like, I can't access those funds. What is that doing for me? And it was a struggle.
And you want to match it, always match it. Like if they're giving you 6%, put in your 6%. That's
Exactly.
free money.
Exactly.
But beyond that, take that money, even if you put it in a Roth IRA, it's a little bit more accessible. Put it in something else that's, don't take it and blow it on a sports car. Though I did buy one years ago, but I could afford it. I was at the point where I could afford a Porsche. I bought it. I've had it for almost 20 years. Every day I smile when I drive that car. It's like 20 years old, but I love it. It still looks brand new. But in any case, don't blow the money. As long as you're disciplined enough to take the money you're not putting in your 401k and put it in another investment vehicle. Even if you do want to put it in the stock market, put it in an index fund, but it's something you have control over. That, you know what, when I'm 38 and I decide that I do want to start a business, or I do want to do something for my family, buy a house for a relative or help someone out, you've got access to the money without paying penalty. Now, I'll admit, during COVID, they gave a period where you can take 100 grand out, each individual, tax free or penalty free. Still have to pay taxes on it, but I didn't have to pay the 10% penalty. So both my wife and I pulled out 100 grand. So there was more money I have available to invest in real estate and other things. Right. So yeah, make sure it's a secret Wall Street does not want you to know, because they make money when the market's up or down. They get their fees no matter what out of it. So make sure you're educated. If you have the opportunity to do it, roll some money into a self-directed IRA.
So what would you say to the objection if somebody says, hey, I have a responsible financial advisor, I trust them. Why should I trust the investing in real estate? Real estate is volatile too. You could lose $300,000. Objections. Somebody could say that. So how would you answer that objection?
I love it when I meet financial advisors, because I go to a lot of events and things like that. And even the local chamber of commerce, I go to that one. And I love it when I get across from a financial advisor, because they're like dead set against it. First off, they're usually on commission asset under management, so they don't want you to pull your money away from them. Some of them are truly. I think I did meet one that, okay, he doesn't get any commission on anything, but he still doesn't really recommend real estate because he thinks everybody should have their money in the stock market. So it's really hard to overcome, because when the professionals are telling you, oh, don't do this, what are you going to do? Well,
right.
Okay, ask that and I've never done this, but I've read this in books. Well, ask the financial advisor what his net worth is and what mine is. I'll guarantee you mine's probably 10x his. So listen to the person that has made the money, that has actually done it, versus the guy that's teaching you to, hey, keep your money in the stock market. But really, I think it is educate. What you're doing here is great, Jeremy. You're educating people on what you can do. Somebody that's actually physically done it. We've got lots of resources on our website, as you do as well. Just educate. And when you're comfortable saying, 90% of the millionaires in the last 2 centuries have invested in real estate. And that's part of their asset management plan. Their investment is 90% of multimillionaires are investing in real estate. Don't you think that's something you should probably do, even though Wall Street says you shouldn't do it? And
Right.
it is the type of stuff we're doing, large syndications. Like we've got, I can talk about this because it's a 506C. It is a deal that I'm allowed to talk about because we can openly market it. Most deals you can't, but this one I can. So it's a $43 million deal in Jacksonville, Florida, one of the hottest rental markets in the United States. That thing is going to print money. And it's an asset. You know what? It is actually insured. So if there's a hurricane or something and our tenants have to move out, you know what? I have insurance that covers my lost rental income. If the roof gets tore off, I've got a great insurance agent, personal friend of mine, Matt Sudica of Obi, and he takes care of us. So boom. You have anything in Wall Street that's insured like that in your investments? And historically, take a look. Real estate continues to go up in value. And if you're investing in the right spots, Florida, Texas, Arizona, where population growth and employment growth is strong, it's, I hate to say it, almost dummy proof. I mean, as
That's
long
right.
as you've got a great operator, somebody that's experienced, and they're buying a solid asset in those locations, there's like 1,000 people a day moving to Florida.
Exactly.
It's hard to compete with that. And you get to talk to the people that own it. You ever talk to the guy that's managing your portfolio on Wall Street? No. Your index fund? No. Your Roth or whatever your IRAs? No. You can
No.
talk to me directly. I own the asset, and you're a
Right.
part owner as well. So I think that's my pitch, Jeremy, and why you should
Exactly.
get some of your money out of the Wall Street.
That's right. It's the absolute worst case scenario is the building gets burned down and insurance pays the replacement costs. Like
It's not going to go to zero like your stocks could. I
exactly.
mean, it could
Exactly.
virtually, it can't because we have insurance.
Exactly. Yeah, and then even if there is a downturn in the economy, people still need a place to live. So,
Yeah. Recession resistant inflation. It's a hedge against inflation because you know what? When inflation goes up, our rents go up too. And when somebody renews after a year, they're going to go up because our costs have went up. So you're not losing that. Oh, okay. Well, inflation went up. It's worth, no, it's not because our rents are going to bump up in pace with inflation. And most businesses can't do that very easily.
that's right. That's right. So talk a little bit more about your current deal that you're working on in Jacksonville.
Yeah, so it's 227 units.
Okay.
It's in a nice area of Jacksonville, Florida, probably 12 minutes from downtown, which is everyone wants to, you know, eat and drink in downtown. It's a really nice area. It's we call it light value add. So a value add means when you're adding value to the property. So we're going to go in, I think we're spending about $6,000 a unit, which is not much. So we're going to go in, we're going to replace the flooring. I think we'll probably paint the cabinets and maybe resurface the tops. I think we may be replacing the tops in that one. So it's a pretty light lift. It's not like we're renovating, gutting it out or anything. It's pretty mellow. It's 95% occupied right now. So it's a really solid investment. So we're going to put gates on the community, on the entrances to make it a little more exclusive and all of that. We're doing a lot of cosmetic stuff because people want to feel proud about where they live. And our tenants are so important to us because we know they pay the bills. So we take great care of our tenants. So that's a pretty solid deal. Minimum investment is $75,000. Our business plan is to hold it for 6 years. And typically we beat that. We'll meet our business plan. We'll meet it less than that. But we're saying worst case scenario, we're going to hold it for 6 years, get all your money back. Plus, it's basically a 2x
Wow.
multipliers,
Okay.
what it is. So we expect to double your money in 6 years. And
Wow.
historically, we've been able to do that in 30 months or so on some of
Wow.
the last deals we bought pre-COVID. So our track record is pretty good, about an 8% return on average. And then internal rate of return is 15% on this deal, I think, which
Fantastic.
is a Wall Street term that nobody really knows unless you're in
Fantastic.
it. But basically 8% return. And then after about 3 years, we're going to refinance it. And then we're going to pull out and probably give our investors 50% of their money back. So if you invested 100, you're getting 50,000 back right then. And that's
Wow.
called velocity of money. So now you can take that money and put it in other deals or invest in something else.
It's
So it's a
fantastic.
pretty solid deal. We feel pretty good. And we own, my partners, I've just sold 3 properties there and doubled our investors' money. And then the partner that I'm working with right now owns another almost 1,000 units in that area. So
Wow.
we've got the property manager that's phenomenal, that takes great care of our tenants. They renovate things. So we've got the track record there. We're local. We're not new to that area. We've got lots of properties we own there. So we've leveraged our expertise there. So pretty
Fantastic. So
solid deal.
So what is the main reason that the investor can double their investment over that period of time, 6 years? Is that due to the value add of renovation, or is that good cash flow? You guys bought the property at a good discount, probably a combination of all those. Can you explain
Yeah,
how that's
I think
possible?
it's a really good. We got it at a pretty fair deal. I think it wasn't a huge discount, but we purchased from this seller another property 5 miles away. So they wanted to work with us. We were certainty of close. We know we're stand-up people, that we're going to do what we're say we're going to do. And a $43 million deal. They don't want somebody to tie that thing up for 60 days and then not close on it. Well, we're going to close on the deal.
Okay.
So that's part of why we got the deal to begin with. But it's a solid one. It's not a heavy lift. So we're expecting on some of these big heavy renovations, it could be a year before you see dividends. This one, we're hoping 6 to 8 months you'll see dividends. But it's a combination of, yes, we're going to clean up the place. We're going to, put gates on it, make it a little more exclusive. And we know the rents are probably $500 a month less than the surrounding
Yep.
area.
Yep.
And it's just because it wasn't managed really well.
Right.
The property manager there, we're replacing the property manager with ours that we deal with a lot. They're going to improve the tenant's experience. And as people move out, we never evict anybody. As people move out, the rents will go up several hundreds of dollars after we renovate them. So it's mostly the value add is we're increasing the value. And here's another, for those of you that are in the residential world, your property is based on the comps, the competition. What are the houses around it? What are the houses around it worth? So you can buy the 250,000 and think it's worth $500,000. If the house next door is only selling for 250,000 or 300, you'll get a little bit more, but you're not going to get the full $500,000 because it's based on what the other houses are selling for. Now, in commercial real estate, like a large apartment complex, it's based on the net operating income. That's basically the profitability. Every apartment is a business. It's its own entity, every apartment complex we own. And it's valued based on how much money it generates. So we call it forced appreciation. You're appreciating the property because you're improving it. You're increasing the revenues by hundreds of thousands of dollars over the course of a year. That's what we do. You have total control over this. I mean, 100% control. You have suppliers and things like that, but you have control over it. And that's why having an experienced operator that's done lots of deals like we have is a very big advantage. And we're big in the area. We've got contractors there. The property manager takes wonderful care of us. We've got the infrastructure to get things done. And so that's really the value add, is like, okay, it's bringing our secret sauce of our property manager. We know the market really well. We know how to take care of our tenants. We know what our tenants look for, because in different areas, when you're in Memphis, Tennessee, the tenants don't want the same thing they want in Jacksonville, Florida. So you need to make sure you know that market. So good question. That's what's the beauty of commercial real estate, is that you can impact the value of your property by the actions you take. You're not at the mercy of the comps.
Right. The value of the property is equal to the NOI divided by the cap rate. It's just, if an investor understands that, the light bulb comes off, light bulb turns on, and you're hooked on real estate, commercial real estate forever after that.
Exactly. Yes.
Excellent. So where can an investor sign up to invest in your Jacksonville deal?
Just go to our website, hansenholdings.com, and Jeremy will have it in the show notes below. And just go out there and you can access. First off, get educated. I want you to be comfortable. We don't take investors that aren't savvy investors that understand what they're doing. They need to know the risk involved. Your money's going to be tied up for 6 years and all that. So we've got a free download called Rethink Your Retirement. Like I wish I would have done years ago. and it talks about multifamily investing and things like that. And there's a little bit of talk about how to move money into a self-directed IRA so you can passively invest with retirement funds. So yeah, check out our website and lots of information there.
When is the fund close? I guess that's a terminology. Maybe
this one is probably going to be open. It's a $14 million raise.
Okay.
So I think this time right now, we're probably more than half of the way through to that. So probably near the end of October, mid-October, we should be done raising for it.
Okay. And
it's one of those we can advertise. So we want to stretch it out a little bit. We want to be able to advertise because it's the type of deal. Most deals, if people aren't familiar with it, are only friends and family. I have to Jeremy can now invest in me in the future because now we have a personal relationship. Right. But before that, I couldn't take his money because I need to know that I'm not taking his last $50,000 or $75,000, and that's all he has. Right. We have a fiduciary responsibility to make sure you're protected. So for that reason, that's why people don't know about this stuff, is unless you know somebody like Jeremy or I, you're never invited into a deal.
Right.
But with this one we're running right now, it's one that we're allowed to advertise. It's a big deal, so we kind of like leave it open as long as we can.
So does the fund closing coincide with the purchase of the property? The closing?
Yes. Yeah. Okay. We close at the end of October, so we want the funds in a few weeks before that.
Fantastic. Excellent. So after this deal, I guess, what are some of your goals, and what's next for Matt?
We already have one in the queue, and I can't talk about that one because that's only for friends and family.
Okay.
And they can't even invest with me now because the deal is already open and live.
Okay.
So we've got that one, and I've got another friend, and so I partner with different individuals that I know, like, and trusted, and known for years. I got a friend in Arizona that's got a deal that I would love to work on, but I'm too busy doing 2 deals right now. So eventually, and that's the other thing, is diversify. Don't, and all my investments aren't sitting in Florida. I've got Florida, Texas, and Tennessee, and I'm eventually going to be in Arizona too. So diversify.
Fantastic. Wow. So this is all coming from somebody who's already worked a lifetime at Dow Chemical, and you got so much more energy than some of the young pups that we've been interviewing right now. So that's impressive how much energy you have. Like, wow, I need to get some of that.
Oh, you're pretty accomplished too, Jeremy. I know your track record. It's phenomenal as well.
I got 5 children, so I'm talking about energy. Waking up in the morning, I got
that's impressive alone. 5 kids. Oh my gosh.
The real trooper is the wife, because she does the 5 children and homeschools them. And so kudos to my wife, Amelia, if she ever listens to this, who knows.
Yes, that's huge. That's such a responsibility. You hear of the people during COVID. My kids are all adults. They're like, yeah, I had to take my 2 kids and I had to teach them. I have a niece and nephew that have 4 kids, and she's like, that was so much. He had to be teaching all these kids. They were glad school was back open, but I can't imagine doing that full time. It is really takes patience.
The oldest,
a lot of work.
Yeah, our oldest is about to turn 11, so we haven't gotten into the courses that need some more expertise. So everything's okay right now.
But you get to the trigonometry and all that stuff, like you would lose me. Oh no, I can't do that. Yes, that's right. You know more than they do at this point. When they get to be teenagers, they can study up on. You have to study up on the stuff. It's difficult. Yeah. Oh, that's interesting.
I'll train them to be general partners and limited partners, and teach them syndication.
See all the stuff you're doing, they're going to want to do.
Well, excellent, Matt. Thank you so much for coming on the show. And anything else you want to say to the listeners, where they could find you again?
Just go to my website, but take the risk, people. And it's not a risk if you educate yourself. So watch Jeremy's show. This is good stuff. He's got good guests coming on here. He's got great expertise. Educate. Then you're comfortable, and then you can invest. But you do need to get out of Wall Street. Get some of your money out of Wall Street. It's the one thing I leave. Get some of your money out of Wall Street. Don't have 100% in there like I did. It's just too risky. That is risky.
Love it.
Thanks so much, Jeremy. It was a pleasure chatting with you.
Excellent. Thank you so much for coming on. And that's a wrap for this episode of the Wealth Building Strategies Podcast.